Assalamualaikum warahmatullahi wabarakatuh. Let me introduce myself. My name is Amanda Safarpogego from Management 23, and my NPM is 2341118. So, good evening, everyone. Today I will a presentation, and the topic of the for the presentation is about international financial management. International financial management is the process of the managing financial activities in a global business environment. It includes decision about investment, financing, and risk management. When a company operates in more than one country, in today's global economy, many companies expand internationally. Because of that, financial management become more complex due to different currencies, interest rate, inflation, and financial regulation. In this presentation, I will explain the concept, importance, key component, risk, and strategy in international financial management. All right, meaning of international financial management. International financial management refers to the management of the financial in a multinational company that operates in different countries. It focuses on how companies raise capital, invest in foreign market, manage currency exchange, control financial risk. Unlike domestic financial management, international finance must deal with multiple currency and different economic conditions. For example, a company in Indonesia that invests in the United States must consider exchange rate between rupiah and US dollar. Importance of international financial management. International financial management is very important for several reasons. First, it helps companies maximize profit globally by investing in profitable international market. Second, it helps companies manage financial risk, especially currency risk and economic instability. Third, it support better investment decision because companies can compare opportunities across countries. Four, it ensure efficient use of global capital, meaning companies can raise funds from international sources. Lastly, it's how companies stay competitive in a global market. Without a good financial management, international expansion can lead to financial losses. Key component of international financial management. There are several key components for insurance management. Companies must manage currency exchange rates because they deal with different currencies. Fluctuation in exchange rate can affect profit and cost. The international investment decision. Companies decide where to invest globally based on expected return and risk. International financial decision. Companies just hold the raise fund, whatever from domestic bank, international bank, or global investor. And the last is risk management. Companies must manage risks such as currency risk, political risk, and economic risk. These components are all connected in globally financial decision making. Foreign exchange and exchange rate risk. One of the most important concept in international finance is foreign exchange. And Exchange rate determine the value of one currency compared to another. For example, if the US dollar strengthens against the rupiah, imported goods become more expensive. There are three main types of exchange rate risk: transaction risk, risk from future payment of reserve; translation risk, risk when converting financial statement; economic risk, long-term impact on business value. Companies must monitor exchange rate carefully to avoid losses. International financial market. International financial management also involve global financial market. This include foreign exchange market, international stock market, international bond market. Companies can raise capital from this market to fund their global operation. For example, multinational companies may issue bonds in foreign countries to attract international investors. International investment decision. When companies expand global, they must decide where to invest. This is decision based on expected return, risk level, political stability, market potential. Companies often use methods like present value or NPV and international rate of return or ERR. These tools help companies compare investment opportunities in different countries. International financing decision. Companies also need funding for international operation. They can get financing from local bank, international bank, issue stock or loan globally. A major decision is chosen between the financial, like loans, equity financing, like selling ownership share. This option has advantages and risks. For example, debt increase financial risk but does not reduce ownership. Risk international financial management. There are several risks in international finance. Currency risk due to exchange rate fluctuation, political risk, change in government policies, law or instability, and economic risk, inflation, recession, or economic crisis in a country. Interest rate risk. Change in global interest rate affect borrowing costs. Company must manage the risk carefully to avoid financial loss. Risk management strategies. To the risk, a company use several strategies, like using financial instrument, forward contract and future contract, diversification of investment across country, insurance against political and economic risk. The strategy help protect companies from under the table from checks. Role of multinational company. Multinational companies play a major role in international financial management. They operate in many countries and must manage complex financial systems. Ex- Example like include Apple, Toyota, and Unilever. These companies manage large-scale international transactions every day, making financial management very important for their success. Conclusion for the conclusion is international financial management is essential for companies operating globally. It involves managing investment, financing, and risk across different countries and currencies. Although it is complex, risk-effective financial management allows companies to grow international and maximize global profit. Understanding exchange rate, financial market, and risk management is key to success in international business. So, just only that what I can explain in here, more or less I apologize. Thank you for the watching. Thank you for your attention. Thank you and see you in the next presentation.